Awesome. As the name says, Finance 101 for startups. Thanks everyone for joining. Just a couple sort of housekeeping or whatever. This is meant to be a bit of a interactive kind of session. So if you have questions, definitely put your hand up, interject along the way. The presentation of itself is probably about 15-20 minutes for the slides I prepared, but obviously we have about an hour. So hopefully we will get some Q&A and some discussion going. So feel free to jump in part way or save your questions for the end, whatever. It's flexible. So, and Zainab, maybe you can keep an eye on people that have questions or whatnot, and you can kind of just alert me or whatever if I don't see them. That would be appreciated. So with that, I did want to start off before we get in with sort of an outline of kind of the 8 things we'll go over. So here's our outline for today. Assumptions and context. So what this webinar is not, we assume that you've already explored, options for self-funding, incubators, grants funding. A lot of folks are familiar with grant funding and writing applications at the university. So this is nothing new. And maybe you've already explored a line of credit, personal, or maybe you have a company already set up. So we're not going to sort of look at those items. We're going to where we're going to jump off is at that point where maybe you're looking to actually officially raise money from third parties, or how to structure an investment for maybe family, friends, these kind of things. So just just want to get that out of the way. But a question, who here, and I don't know if I can see everybody, but we can kind of maybe show of hands or whatever for the people that do have their monitor or videos on. Who here thinks, would like, if I said you could expect a 6 to 8% rate of return, who thinks that's a good rate of return, or who would like that? I'm assuming people would. Thank you, Salman. Elizabeth, thank you. That's a good rate of return. Okay, perfect. Sammy, I see the thumbs up. That's excellent. So that, I would say that's a good rate of return, but I would put a caveat on that. I would say with what amount of risk, right? And so the next slide here, there's a slight spelling mistake. It should say Sharpe ratio, not Sharpe ration. But Sharpe ratio is a way to think about investments. And so we're not going to do any hard math here on this talk or this tutorial. But the key inputs here are on the top, we have a measure of return. So you've got the return to your portfolio or your specific investment, what have you, and then we subtract off a risk-free rate. So essentially on the top is sort of your excess return. On the bottom, we have what's called standard deviation. And this is a measure of risk. There's different ways to calculate risk. Standard deviation is just one. And for our purposes today, we'll just treat that as just a general sort of risk number. And so the way that a lot of investors or people that you're going to approach or want to invest are going to, most rational investors will think about a return for a given level of risk, right? And so that 6 to 8% rate of return, if it's really low risk, then that's a really good investment. If that 6 to 8% is super high risk, then I'd say maybe you're not getting enough return for the risk you're taking, right? And so the Sharpe ratio in and of itself, you could think of it, all investments should have the same constant, right? If you have a constant Sharpe ratio with all investments, then you're sort of getting the return for the amount of risk you should or that you're taking on, right? So if you have a number that's below sort of the average Sharpe ratio, then you're taking on too much risk and not getting enough return. And obviously, if you have a higher Sharpe ratio, you're getting more return than for the risk. And that's a good thing, right? So at the end of the day, investors are looking for the highest return for the least amount of risk. So all that to say, when we look at the context of startup finance, or what we're talking about here is, for most of you, pretty much for everyone that's starting up a company, tech space, spinning out something from the university, you're going to probably fall into, you know, a higher risk bucket, right? So here we have, you know, sort of just a basic portfolio composition that most investors, people will have some, you know, to some varying degree here. So on the left-hand side, we've got the low risk. This is your savings accounts, your government bonds, GICs. And the expectation here is you're not going to lose money, but you're not going to make a ton either, right? Currently, savings accounts are like 0.5%, 0.25%, these kind of things. In the middle, you've got your sort of medium risk. And as you can see there, the expectation is to win over the long haul, right? And so these are going to be your RBC stocks, and, you know, maybe Imperial Oil and some of these larger publicly traded companies, where you don't expect to lose your money with RBC or CIBC or whatever, you know, large blue chip stock that you have. And by and large, most investors that you meet are going to have probably 80 to 90% of their money tied up in these two categories, in the low and medium risk. And so that when you approach them, when you're talking to, you know, investor, their portion of the portfolio that they're going to be looking at to invest in tech startup, you know, in a spin out from the university, is going to fall into that third bucket, right? They expect to lose money. It's a gamble, right? Which is why a lot of them have 10, 15, 20 different companies, or if it's in a venture capital fund, then you're going to have, you know, maybe 50 to 100 different opportunities in there. And they expect that maybe just 10% of those, you know, 5% of those will actually win quite big, right? And so the reason I put this up here and talk about that is, you can't go to an investor and say, I've got this really cool idea. It's some awesome tech coming out of the university, and I think I can get you a 5% annual return on your money over the next 20 years. They're going to say, no, thanks. Nice to meet you. Do you know anybody else that can give me what I need? You know, and what they're looking for is, you know, they define success. Success is defined in this area as 10 times your money, getting back 10 times. So if you don't have a story, if you don't have a pitch, if you don't have something compelling to say, you know, to get them to believe that you're going to change the industry, the world, whatever, and blow this thing out, you're not going to get their attention. They're going to say thanks, but no thanks. Right? And so just make sure, you know, whatever it is you're working on, that you can make that story where you've got, you know, these sort of super returns, because you won't get their attention otherwise. Does that make sense? Any questions, comments? Anybody? Oh, we're good. All right. So again, this next slide here is a bit of the same theme of what we were just talking about, but it just puts it sort of more in a graphic form. But again, you know, we see startup investing as a gamble, right? 1 out of 10, 1 out of 12 actually succeed. And so you have to have an expectation of a large return. investors won't give you the time of day if you don't, right? And I've sat on pitches and listened to pitches where a 6% or an 8% return is promised, and that's all fine and well, but people are just missing the risk portion, right? And if that's the one takeaway from today, is just, where do you fall in terms of your startup and your raising money, is it's going to be that high risk bucket. And so an appropriate return needs to be expected, and you have to show how you're going to get there. So where are we now here? So moving on from there, one of the things I see often, which can be a little bit confusing to people, is, you hear terms like pre-seed and seed and Series A and Series B, and what does that actually mean, right? And there's no sort of hard and fast sort of rule on what those, where one leaves off and where the next one goes, and then they keep coming up with new terms like it's a pre-Series A. I'm like, I don't know what that means, right? But generally, we tried to break it down, and again, this is just a hypothetical kind of example. Dollar amounts and stuff in here might not necessarily follow exactly what you might see in the real world, but just as a general overview, at the top left there, you can see pre-seed funding. You're probably going to get your funding from founders and the 3 F's, family, friends, and can anyone tell me what the last F stands for in the 3 F's? I think Sean knows.
Fools?
Fools, yeah. They call them family, friends, and fools.
No offense,
whether
of
that's
course.
true or not, I don't know. And maybe Sean has some experience with that. But anyway.
Hey, now.
So this is going to be, your sweat equity, throw a little bit of cash in for the founders. You guys are sort of bootstrapping and throw a bit of cash. If you do find some friends and family that want to throw in, typically these are going to be, your smaller dollar amounts, maybe, as small as $1,000, a couple $1,000 up to maybe 50,000. It could be a bit higher, depending on how rich your friends and family are, and if you have any compelling evidence to get them on board, or you can blackmail them in to investing. I'm not sure, but and typically this is going to be, maybe your proof of concept, where you're establishing your idea, and you're kind of at that stage. Moving up, maybe you get into the seed round. Now you've got a prototype, maybe actually got a product development strategy. You've got some interest from some maybe larger companies. And this is where you would attract sort of those angel investors. Angel investors are typically high net worth people. Maybe they're just investing on their own behalf, not necessarily on a fund or anything like that. And they're just, wealthy guys that want to play in that space, and they want to throw a few bucks around. Typically they might want a board seat or want some input in your business. They might be an expert in your field as well. Moving up from there, then we have our Series A and B, which are typically going to now starting to attract sort of those early stage venture capital funds, private equity guys, those kind of things. And the check size is going to start moving up. But you've now got probably a product, you've got, maybe some initial sales. And so you've proven the market. And that's a big one for a lot of these guys, is if you look at the Jobber example. I don't know if anyone's heard Jobber speak on how they fundraised and whatnot, but they raised 250,000, I think, from some early stage guys when they only had $1,300 of revenue per month, right? They had like 6 clients paying $200 a month or $250, something like that. And so in your Series A and B, you're typically probably have some sales, not just proof of concept. and prototype, but you actually have some validated third-party sales, and then those guys, you can see the check amounts here. They're looking, 250, 500 million dollars. They've got money they need to place. Going up from there, your C and D. Now your Series C and D. You're looking at production and scaling, and sort of expanding your market. And you can see the check sizes there. And then from there is the public markets and hedge funds and that kind of thing there. So I might just pause here if there's any questions on this or anything that's not clear. If anybody has comments.
Scott, I've got a question just to pose. Sure. You at the beginning you talked about the investment and risk and expectation for return. I don't know if you will address the expectation for timing. Is there an when there's risks involved and for these high risk university type of technology, can you comment a little bit about investors' patience? What's realistic for innovators to pitch investors in terms of expected time till they see a return?
Yeah, no, excellent question. Thanks, Chris. Yeah, you've got to be realistically, you've got to show some return, maybe not a full return of capital, but you've got to show some return in 3 to 5 years, right? Some guys might want it sooner than that. Some guys maybe a little bit longer, but obviously there's delays and things like that. But if you have your expectation of 3 to 5 years where you have an exit or some return to the investors, that's what they're typically looking at. A lot of the seed funds and Series A and B funds, we talked to Arden a few weeks ago, and they typically, and most funds do this, they set up as a limited partnership. And typically limited partnerships are structured for a 10-year lifespan. And so they're not looking for a return at the end of 10 years, they're looking for returns through that. And so as they raise money and as they place money, they're going to have their initial round of investments into companies, in year 1, 2, and 3, and they'll be looking to exit over the next 3 to 5 years. And so that's why they set it up as a 10-year typically, so that they can place most of their money in the first 3-4 years, and then their return expectation and winding down the fund happens by year 10. But good question, Chris. That's
I find for when we're looking at investments, length of time is often dictated by potential return as well. If the return is smaller, then people are less patient. If the return is potentially enormous, a little more patient. So that's something innovators should keep in mind when they're putting their pitch together. What's the potential return? And based upon that size of potential return, how far could I push the timing in terms of their expectation? And I think 1 to 3 years is pretty typical. Once you get past that 3 years, you get to 4 or 5 years, you're expecting a very patient investor. So you better have a really good reason for them to be that patient.
Yeah, and it can be dictated a bit too by the specific industry. As we know, in say pharmaceuticals and drug discovery, there is a bit of a longer time horizon with approvals and stuff like that. But like Chris said, yeah, that 1 to 5 years is kind of where you need to be targeting, and obviously the shorter the better, right? Investors get nervous when they have their money out too long, and especially if communication is poor, they get even more nervous. So thanks, Chris. Good question. Next slide here is, we've talked about return expectation. We talked about, the various stages of investors and stuff like that. And what I wanted to get into here is the form of investment, right? So now once there can be, various forms of how you actually take money in. And so this is just sort of a broad sort of brush on capital structure and forms of investment. So starting at the bottom, you can imagine any sort of debt, if you have a house or a mortgage, everyone knows that the bank has the first claim to that property, right? So you've got your senior debt, and it's no different in raising money or with companies, right? If you go to the bank and you get a line of credit or a loan from them, they're going to want to take a first charge over all of your assets and IP and whatnot. Then moving up from there, you've got sort of in between sort of the bottom and the top, you've got what we call hybrid securities, and they can take the form of subordinated debt. So if in the house example, if you have a mortgage with RBC and they mortgage your house to 70%, if you went and took a second mortgage or got a second loan from a different lender, that would be what's called subordinated debt, right? So that second, it's still a loan, it still has interest in terms of repayment, but they would be behind or subordinated to your first lender, which is in this example is RBC. Then you have the sort of the hybrid financings, which are convertible debt, and that's our convertible equity, where for example, if you can make a loan, somebody would want to make a short-term loan to your company for, say, a 10% interest for 2 years. And then over the course of those 2 years, the investor would have the option to convert to equity. And so why would somebody want to structure something like that? Well, it's kind of the best of both worlds. You're getting some cash flow over the short time frame or short horizon of 2 years, but then you also get the upside. So if there is, your investment or your opportunity is looking like it's taking off and getting more funding and market share and scaling and stuff like that, then the investor has the option to then convert into equity and take their debt and move that into equity, and then they get the upside, right? What it does on the other side is if the investment isn't going anywhere, then at the end of 2 years, the investor has the option to say, hey, give me my cash back, and we'll just walk away. Then going up from there, preferred equity is a form of investment where you're a shareholder, but you get a preferred dividend, maybe 2, 3, 4%. And in a lot of cases, it's cumulative. So if you don't pay out their dividend in the first year, you have to pay it out, in the next year, and you keep earning sort of 4% per year. And then at the top is your common equity, which by and large, most startups prefer common equity, but it is a balance, right? As you're raising money and talking with investors, there's going to be a balance between what they want and what you want to give up, right? If you're at the bottom of this scale and they want debt, well, debt is much more restrictive on you as an investor because there's an annual interest rate that you have to pay. They typically take security. Maybe they want to charge over your equipment or assets or whatever. And then there's a term. So at the end of 3 years, 5 years, whatever, they want their money back. And if you can't pay, then they're going to come in as a creditor. Just like your bank on your mortgage, if you don't pay your mortgage, then the bank will come in and they'll take your house and sell it. And so the debt options are a little less attractive from, if you're an inventor and you're starting a company, because you could essentially lose your IP or your equipment or whatever if you don't meet those terms. But it's going to come down to a negotiation, right? If you have a lot of investors at the table and you're only wanting to raise a small amount of money, well, then you're in the driver's seat, or you can negotiate what you want. But if you only have one investor and you're desperate for the money, well, then you're going to probably, be more of a taker of their terms, right? And so again, it's a bit of a balance. There is a bit of a difference in risk profile between debt and equity. But when we're talking about startup companies and stuff like that, the whole, whether it's debt or equity, we're still in that whole sort of bucket of high risk, right? And so you might be able to get a little bit, negotiate a bit of with the debt piece, a lower return than equity, but by and large, it's probably going to be similar, just given the high risk nature of where we're playing and which bucket we're in. So any questions there, anybody?
Yeah, I had a question, Scott.
Sure.
Regarding debt, is it possible to restrict it to IP, just back it by IP, and we cannot basically pay back? The investor would take the IP.
Yeah, for sure. You can do all sorts of things. You can have specific collateral for your debt, right, and exclude others, right? It's not unlike, let's say you have a company and you lease a bunch of vehicles in that company, right? The leasing company will have a first charge over each one of those vehicles, but they won't have a claim to any of your other assets, right? If you have a building or equipment or stuff like that. And so those types of carve outs happen all the time. So if that was what those investors wanted, or that's what gave them their comfort is the strength of your IP, then certainly you could carve that out as a specific collateral for the debt, for sure. So that's an excellent question, Salman. There's two sort of forms of collateral. One is sort of your general. You'll see a general security agreement is called, or GSA, and that will take a sort of a claim over all of your assets. And you'll see that with your bank line of credits. They typically register a GSA. Or more to your point, then there's specific collateral that you can take. So those are your sort of two options. Good question. Thanks. Anyone else on this?
And just to add just a little bit for Salman, when I was raising money for Fedora, I did not give any personal guarantees. I presented an offer to investors. I had a lot of angel investors interested, but I had a lot of skin in the game. I was all in on it. So if the venture failed, I'd be on the street. So depending on how much skin in the game you have, that might be enough for the investors. If you have no skin in the game, then the investors are going to want more guarantees. So there's no rhyme or rule or reason, but it's usually related to how much skin in the game that the innovators have, as opposed in terms of how much security they're going to want on their investment. But if you're all in and you don't have a job at the university, you're going all after this, and if it fails, you're going to be starving on the street. Then an investor's probably not going to ask you for extra guarantees, because if you fail, you're going to be homeless. So like I said, there's no rhyme, there's no rule in terms of how to handle that. It is a negotiation, as Scott says.
Excellent. Thanks, Chris, for jumping in. So this is kind of the end of the presentation, and so all of this is good and fine, but like Sean and I have these odd conversations now and again. It's so what's next? How do I actually do this? How do I meet people? What do I prepare? How do I actually transact, right? And so Sean brought up a good point when we were previewing this, and he said, a lot of a lot of times we go through this exercise and we're talking to people and we know some of this stuff. He goes, but be prepared. He goes, you might be talking to someone and they say, okay, I want to invest, right? And it's like, oh crap, what now, right? What do I do now, right? I want to take your money, but I have no idea how, right? And so a few of the things to prepare is, have a bit of a budget or projections, and what amount of money do you need? What's your minimum amount that you need to move this thing forward, and then have your sort of, base case, and then your best case of, maybe it's 1 million's your minimum amount, but you can take up to 3, right? And know what you're going to do with each one of those amounts of money, right? Have a use of funds table. Well, we're going to hire people, we're going to, develop more IP, or we're going to, develop our product, or, start production, whatever it is, right? Be prepared to answer those questions. And to Chris's point, what are your exit options, right? An investor says, how do I get in? But they want to know, how do I get out, right? And so maybe you have along, your projections there, maybe you have some options. Well, if we hit this projection, then, we're going to raise some additional money, and you can get out at that point when the new investors come in, or whatever, we're going public, or we're going to be bought out, some of these things. And then along with that, what's the return expectation, right? In 3 years, you're going to get, a 500% return, right? Based off of these assumptions, right? Build out your model. If we hit these market targets and production and stuff, then we know, working backwards, that's going to be X amount of return. The issue with the return expectation is you have to be careful from a securities point of view that you cannot promise or guarantee a return, all of these kind of things. And as you're actually raising money in subscription agreements, there'll be sort of these caveats in the documentation, but you have to sort of balance with investors, give them some sense of what the return could be without promising, we guarantee you will get 100% return, because obviously you'll get in trouble, and you can look on the ASC website and they've got all sorts of people that they've fined and banned for making those kind of promises. So, and then at the bottom of that list is a data room. Think about what you would want to see in an investment if you were putting money in. Obviously, you're going to want to see patents and a bit of a business plan and whatever other documentation that they need to make a decision, right? With startup and university spin out type stuff, typically it's going to be the patent and maybe some market research and a bit of competitive advantage, right? What's how is yours better than sort of everybody else's? And then to again, to Sean's point, so how do you meet people? What are the mechanics, right? And unfortunately, there's no hard and fast sort of rule. It's not, if you show up at this party, you will meet these people and they will give you millions of dollars, right? You have to be prepared to talk to everybody, right? A good starting point, especially for startup out of the university, is I'm sure everybody knows somebody in their faculty or the faculty next door that raised money, spun out a company. Talk to them, right? They'll have sort of good sort of boots on the ground, sort of first experiences on how to do that, and some key learnings there. Be a part of an accelerator, right? imYEG, you're getting exposure to mentors, and when it comes time, those mentors are investors and they have friends and know people. Talk to them, right? We've done some investing at Brass Dome where we've met, got opportunities through an accountant, friend of Chris's accountant. He brought an opportunity and said, hey, would you guys be interested? Right? So talk to the accountants, lawyers, you can even, I remember Sammy and I were down in the States at an event, and they had 3 different VCs up on stage. and they said they get hit on all the time, right? Whether it's through LinkedIn, email, just, you know, a lot of these funds have their own portal where you can just submit an idea, and they literally review hundreds to thousands of these per year, right? So if you're going to go that route, your pitch has to be tight. You have to show how you're going to, you know, blow it out of the water, because they have literally, the one guy was like, I have 15 minutes to half an hour to review, you know, these kind of opportunities, because hundreds and hundreds of them, you know, it's got to float to the top pretty quick for them to even take a look. So if you are going to go the VC route, sort of cold calling, make sure you've got a great executive summary and overview to whet their appetite. And then the last thing, you know, some crowdfunding. You know, I've seen some things with, you know, WeFunder and stuff like that. You know, they take their cuts and their commission, but they do have networks of people that will throw in small amounts. So that's also an option. There are some securities rules around number of investors and stuff like that. So that's a little bit probably outside of the scope of this talk, but crowdfunding is certainly an option there as well. So with that, I think we've sort of come to the end, and as Zainab put on this slide here, Startup Genome, I don't know if you guys know them, they do a report on startup accelerators around the globe, but they, you know, according to their report, 1 in 12 are successful, right? And they define, I think they define success as a 10 times return on your money, right? And so, like we started off in the talk, you have to have that big return to attract. So we know that the success rate is lower in this bucket, but if you can do some of the right things and help mitigate some of the risk and fears and stuff like that, then hopefully your venture is one of the successful ones, right? So, and like it says, yeah, I think that's it. So thanks everyone for listening to me ramble on, and hopefully there was a few nuggets of information or aha moment or something in there that's useful. So with that, any questions, we'll sort of open it up.
Scott, I have a question.
Sure.
In regards to the financials, when you're talking to investors, sorry, my camera is off. I don't mean to be so rude. In regards to what the investors want to see for financials, so can you comment on what do these financials need to look like? How long you're projecting for? That's part A. Part B, we've noticed with some of the innovators that there is an expectations that they would like to also get paid a salary out of the proceeds from the raise. How do the investors look at that? Thank you.
Excellent two-part question. Thank you, Sammy. In terms of you know, projecting out in timeline, I would say at a minimum you'd want sort of that 5-year projection, right? Obviously with a return expectation or return of funds of, you know, that 1 to 3 to 5 year period, you'd want to minimum project out your financials for 5 years, and you'd want to, you know, obviously throw down all your assumptions as to you know, what you're basing those projections off of. But it would be useful, like I said earlier, with the venture capital funds they typically have a 10-year life on their funds. So you might want to actually do a 10-year projection. Anything after 5 kind of gets a little bit sort of, you're kind of guessing a bit, but it doesn't hurt to project it out. And then with that, I would say make sure you have sort of do some scenario analysis or sensitivity analysis, where you have sort of your base case, your worst case, and your best case, right? Investors are going to want to see that. You know, they don't want to just see a nice graph that goes up and to the right. in a straight line. They want to see that you've thought about, what happens if there is a bump in the road or there is some risk or whatnot. So I think that's part A. Sean, I see your hand up. I'll grab you in a sec. In terms of salary, that's tough, Sammy. The issue there is kind of like Chris alluded to, is if you're not all in, and this looks kind of like a side job that you're doing off the side of your desk, and you just want to get a salary and you're still working your full-time job, nobody wants to pay, have your money just go to fund a founder's salary. Obviously, there is a bit of a negotiation there where if you're all in and you don't have any other source of income or these kind of things, then you say, hey, I need a basic salary, to keep the lights on and, pay the rent kind of thing. I think there'd be more of a willingness there, but it kind of goes more to how all in are you on this project? So, does that answer your question? Thanks, Ed.
Yes, thank you.
Sean.
Yeah, thanks, Scott, and well done. My question's around, and you've touched on it, but like on assumptions, right? So I think we often sometimes innovators will get grilled by investors around like, where did you come up with that number? And I guess my question is, Chris is fond of the term NUMA, for those of you who don't know, and that's number out of my, and we're in polite company, so I won't finish it, but it's that idea that, but it has to be more than that, right? It can't just be a finger in the wind trying to figure out numbers. So what I wanted to ask was just how much do you need to show your work around assumptions? So for example, on exits and exit scenarios for investors, is it helpful or even expected to show like comparable exits, maybe other sort of companies in the same sector and what they've done and what sort of valuations they reached, et cetera, as opposed to just saying this number is good? And I think, Chris, thanks for that. And to show that work, like how important is it for investors to see that these numbers are based in some reality?
Yeah, no, great question, Sean, and thanks for teeing that one up. It's vitally important, right? Obviously, if you can show some comparables, unless you're truly, a pioneer in the industry, and there are no comparables, then I guess it would sort of be a NUMA. But for the rest of us, where there are comparable data and we know some of the competitors in the space, certainly you must do that homework, right? Where not even just on the exit side, but where you can list 3 or 4 exits in the space, but even on your revenue projections, right? If some of these competitors and stuff have public data, you could go in and look at sales forecasts and historical sales numbers and see how quickly they scaled up and were able to reach into the market, right? Because with most investors, not all, but most are sophisticated enough that, and especially if they're experts or they're knowledgeable about your space, they're already going to have that knowledge, right? And so if you come up with just I did this, they're going to call you out and rip apart those projections and those financials, right? So you need to do your homework there. And even some of those potential investors, if they are in your space, you could even ask them for information and pull them in. But yeah, certainly you definitely need to do the homework.
Scott, I have one last question, unless any of the innovators on the call have any specific questions. You did mention SEC, the Securities Exchange Commission, a few times. Can you just comment a little bit? I know it's a big scary thing when innovators go out raise money, especially when they hear coming offside with SEC. Can you comment regarding accredited, non-accredited investors, especially when you're starting out and doing the family friends round? Just comment a little bit about that on how to stay on side.
Yeah, 100%. Good question, Chris. So when we look at, securities rules, like when you think of public companies and they've got their annual filings and their quarterly filings and stuff like that, there is a whole body, a whole body of legislation and rules that every issuer or anybody raising money must follow. And so it's big and scary and it's a lot of work. And then they have what's called exempt issuers. And so they've got this whole body of rules that say everybody must follow these. And then they set them to the side and say, but if you fall into this category of an exempt issuer, then we will exempt you from all those rules. But there still is a set of rules you must follow. They're just a lot less cumbersome. And so in that exempt world, you will typically find, sorry, let me back up just 1 second. Though all those rules, the securities rules and commissions, all those rules there are meant for two things. One is to provide transparency of information, and two, to protect investors, right? And so the securities commissions aren't against risk taking or anything like that. They just want to make sure everybody has the right amount of information to make a decision. And if it is a risky investment and you lose money, well, if you had all the information to make a decision, then that's on you. So the exempt space where 95% of startups would fall is going to be a little less transparent. And so the Securities Commission, and it's going to be higher risk, super high risk. And so the securities commissions say, we're only going to allow certain people to invest in those types of issuers. So your general public that the Securities Commission is trying to protect won't be allowed to play in the exempt space. And so any issuing documents or subscription agreements that you have will come with big warnings that say you can lose all your money, and that's it, right? You're not allowed to say anything sort of more than that in your subscription documents. But they will allow certain investors to play if they meet certain criteria. And those criteria are what is called sophisticated investor rules. And so if you fall into a category, the biggest sort of, there's about 10 or 12 different categories. If you're a venture capital fund or you're a fund of a large bank and these kind of things. But the ones that apply mostly for our situation here are going to be the accredited investors, which are typically high net worth. And they have a test, which is you have to have over a certain income or a certain net worth threshold. And so that would be sort of the biggest two. For family and friends, if you are a friend, and friend is defined fairly narrowly, if you're a friend of the founder, you can invest if you don't meet the high net worth sort of criteria. But there are some rules around what defines a friend. And then typically they restrict the number of investors that can invest to like 50, right? So they don't, again, the securities commissions, they're out there to sort of protect the general public. So they want to, make sure anybody invests in these exempt offerings are, it's a smaller group, high net worth people. And basically what it is they don't want, the reason they want high net worth and sophisticated investors is they don't want this investment to wipe them out, right? these people. You don't want to put grandma's pension money into something like this, right? Because then that's where they get complaints, and there's all sorts of sanctions and fines and things that can go along with that. So they just want to make sure everybody that's playing knows the risks, can bear the risks, and it's not going to sort of wipe out their net worth, right? So.
Well, thanks so much, Scott. Any other questions? I see Simon, you have another question?
Yeah, I have one final question. You did talk about the risks of investment. I was wondering if you could comment on the risk for the innovators or for the company. If we talk to different investors, what are the risks for the company? Because some of these investors are not going to eventually invest in the company, right? And,
yeah, no. So you're saying, what's the risk for you taking money from investors, correct?
that's correct. And also, what if they don't invest in the company and they would go and invest in another company? That's also a risk, right? If they invest in a company there or companies with similar technologies, they know what we are doing, and then they know what the other company is doing. So there's some risk for our company.
Right. Yeah, and those are great questions. So in terms of risk to you as an innovator, it's, when we looked at the scale of pre-seed, seed, Series A, Series B, Series C, Series D, at the sort of, left-hand side, or the earlier stages, you're typically going to probably just find, a high net worth individual, or somebody that's interested in the space, or, an expert or somebody, and it's probably not going to be as high risk for you at that point in terms of taking someone on like that, right? The risk there is you might have to communicate with them a little bit more. You're almost bringing them onto the team, from that point of view. But as you move up into Series A and B, those guys dictate terms, right? If you're taking 5 million from a venture capital firm, they have their list of, this is how we're going to give you our money, and you will take it, right? And so the risk there is all those terms that they put on you and conditions, right? But if they're if you got one guy giving you $1,000 and one guy giving you 5 million, you kind of expect them to probably negotiate harder and dictate terms. To answer your sort of second part of your question, where you can cover yourself off is, if you get somebody, you give them all your data and you look at their data room and stuff, and then they say, okay, thanks, no thanks, and walk across the street and invest in your competitor, is you have to tie them up with a non-disclosure confidentiality agreement, something like that. And there is maybe more risk with a smaller investor that doesn't maybe understand some of that and will go out and talk more to everybody. But the larger investor, they're going to be acutely aware of non-disclosures, and they're not going to want to sort of even be, smell like they're encroaching or anything like that, because it'll just open up a whole can of, worms legally for them, and they don't want their fund tainted, right? So those guys, not in all cases, it's not a hard and fast rule, but those larger investors are probably a little bit more attuned, right, with non-confidentiality or confidentiality agreements and non-disclosures. So.
Also, strategically, Salman, when you're out raising money, you're talking to a lot of people, and not everybody, and you don't want everybody signing non-disclosures right off the bat. So it's a good strategy to have your investment pitches not give away your secret sauce until somebody comes across the goal line and really expresses an interest. So you should probably strategically anticipate pitching to a lot of people, do it in a non-confidential way until you get interested people wanting to explore that further. Then you can narrow it in under non-disclosure. But non-disclosure, you'll probably lose a lot of people that want to hear about the investment if you ask everybody to sign a non-disclosure right up front. And so I think that's another way to protect yourself. But the only way is really under non-disclosure. And then do you have the resources to go sue somebody that steals your trade secret? That's what you have to consider as well. Any other questions from anybody that we can't see on the call that are here listening in? Well, thank you, Scott, for pulling together this information. I know we sometimes take it for granted because we're in the business, but I think it was a great overview on what to expect. Obviously, it'll raise a lot of thinking and thoughts for our innovators. But please reach out to us anytime. This is kind of what Rathstone does for a living as well. So if you have any specific questions that pop up, feel free to reach out to us. We're happy to answer those questions. But great information, Scott. Much appreciated.
Yeah, thanks everyone. Hopefully there was something useful there for you, and thanks for your time.
Thanks, Scott.